Financial ratios, their relationship with financial performance, and their usage. What are financial ratios? Financial ratios are tools used to analyze a company's financial condition by comparing data from financial statements. They help assess the financial health of a company in various aspects. Key types of financial ratios include liquidity ratios, measure a company's ability to meet short-term obligations. Examples: current ratio equals current assets, current liabilities. Quick ratio equals current assets inventory, current liabilities. Profitability ratios measure a company's ability to generate profit from its revenues or assets. Examples: net profit margin equals net profit, revenue. Return on assets, ROA, equals net profit, total assets. Return on equity, ROE, equals net profit, shareholders' equity. Solvency ratios measure the company's reliance on debt. Examples: debt to equity ratio equals total debt, equity. Activity ratios measure how efficiently a company uses its assets. Examples: inventory turnover equals cost of goods sold, average inventory. Receivables turnover equals credit sales, average receivables. Market ratios measure how the market values a company. Examples: price to earnings, P/E, ratio equals stock price, earnings per share. 2. The relationship between financial ratios and financial performance. Financial ratios are closely linked to a company's financial performance. Each ratio provides different insights into the company's overall financial health. Liquidity ratios show the company's ability to meet short-term obligations. A high liquidity ratio indicates financial stability in the short term. Profitability ratios reflect how efficiently the company generates profit. A higher profitability ratio suggests better efficiency in generating income from revenues or assets. Solvency ratios assess the extent to which the company is financed by debt. A lower ratio indicates that the company is less reliant on debt, reducing financial risk. Activity ratios measure how effectively a company manages its assets, such as inventory and receivables. Higher ratios indicate greater efficiency, which can lead to improved cash flow and profitability. Market ratios give an indication of how the market perceives the company. For example, the P/E ratio helps determine if a company's stock is valued appropriately based on its earnings. 3. Uses of financial analysis. Financial analysis is essential for making strategic decisions. Here are some key uses of financial analysis. Evaluating financial performance. By looking at financial ratios, companies can assess which areas need improvement. For example, if the profit margin is declining, the company may need to review its cost structure and revenue strategy. Planning and budgeting. Financial ratios help companies plan their budget needs and make realistic financial projections for the future. Investment decisions. Investors use ratios like the P/E ratio and ROE to determine whether a company's stock is worth buying based on its financial performance. These ratios provide insights into the company's growth potential and profitability. Financing decisions. Solvency ratios like the debt-to-equity ratio help companies decide whether to rely more on debt or equity for funding. These ratios also help assess the company's ability to meet long-term obligations. Risk assessment. Financial ratios like the current ratio or debt ratio help identify potential financial risks. Inadequate ratios may signal liquidity or solvency issues that require mitigation actions. Conclusion. Financial ratios are valuable tools for evaluating a company's financial performance and health. By monitoring key ratios, companies can identify areas for improvement and make more informed decisions. Whether for internal management, investors, or creditors, financial ratio analysis provides the insights needed for better financial decision-making and long-term success.